If you're a man or a woman over 55 in Australia, your biggest financial risk right now is not the stock market, it's not interest rates, it's not the government, it's your psychology. Because at this stage of life, the game changes. When you're 25, money is about growth. When you're 40, it's about accumulation. And when you're 55 plus, it's about behaviour. Behaviour is driven by a mindset. Right now in Australia, the average balance for men between 60 and 64 is $430,000 to $450,000. Not bad. ASFA recommends a comfortable retirement for a couple is between $690,000 and $750,000. It's a pretty big gap. That figure also assumes that you are on the age pension pretty quickly. Within 5 years, those people retiring with a $750K balance can be eligible for Centrelink pretty quickly. And if you're intending to be a self-funded retiree, that number's a little short. ASFA talks about a comfortable retirement of $70,000 per annum. And this is a pretty tight budget, especially if you're earning, say, a family income of 100 to 140K. Trying to come down just to a 70K income is different. Maybe it comes down to if your home loan's all covered and there's basically the house paid off. Yeah, that's something you can live off, but it's certainly something to think about. In terms of today's episode, it's a solo one. Phil's away, so I wanted to do something that I'm super passionate about, which is the psychology of money. It's something that I think is really applicable to really anyone, and it doesn't matter how much money you are earning. It's a framework that you can add on a income of 50,000, 100,000, 200,000, doesn't really matter. Principles are one of the best things that you can possibly do when it comes to implementing a retirement plan and not gambling or seeing the news. And for example, we did a podcast about 3 or 4 weeks ago now on the gold and silver. It's coming into mid-February and I've already had 2 clients today ask me about how they can sell or buy gold. It's funny how this lag comes through. That's the opposite of good principles. Good principles are long-term planning in a diversified portfolio and not chasing whatever's the hottest things at the moment. The YouTube analytics are telling me to make more content about gold buying. I'm not doing it. We've already done an episode. If you're thinking about your good retirement planning goals, this is the episode to listen to. Anytime between the 60s to the 80s, you have probably had some inherited beliefs when it comes to money. For example, money doesn't grow on trees. Rich people are greedy. Be grateful for what you have. Those weren't lessons, those were inherited scripts, and those scripts still influence how you might spend your money today, how you might invest, what you feel comfortable spending your money on, and how comfortable you are when it comes to retirement drawing those funds down. We see some clients as well who've got enough money that they can retire early and they actually are a little worried and they're just not comfortable. That's based on a money story that they would have inherited somewhere along the way about, I'm going to lose everything, so I need to keep working. And yes, I know I do talk a fair bit about those extra 3 or 4 years at retirement in the workplace do make a big difference. But if your balance is big enough or if your spending's at a level that you're comfortable, that's a great psychology trick of, you know what, I'm okay. I can deal with this. It's going to be all right. The second thing is the wealth ceiling, your income thermostat. For the past 30 years, we have a level of income that we are willing to get ourselves towards. And as we keep pushing, and the income thermostat keeps going up, it's something very comfortable with. It's why sometimes you'll see some people who are earning a lot more than you, but they're working a lot more hours than you are. And conversely, some people are just happy to work part-time. We've all got an internal money thermostat, whether we want to talk about it or not. And it's something that's incredibly powerful that pushes us forwards, but it's also something to be very mindful of what your internal money thermostat looks like. Have a think about it. What is it? Now, here's where it matters. Imagine you are 55 plus, getting ready to retirement, and you might be someone who says, I'm someone who struggles with money. Or you might be someone who says, I must protect every dollar. Even when you've got that funds that's coming from your superannuation, we move you to retirement phase, you're still going to be acting in that same way with that same mental model. The numbers might say that you're going to be fine, but your money thermostat and your identity might not. If you want confidence in retirement, you must adopt this identity. I'm a man or a woman who manages wealth calmly and intelligently, not someone who's just surviving. I'm going to say that one again because it's so important. I'm a man or a woman who manages wealth calmly and intelligently, and I'm not just surviving. The third one, assets versus liabilities. In the retirement phase at 55 plus, this conversation shifts. You're no longer building from scratch. You're allocating. Assets equals things that put money in your pocket. Liabilities, things that take money out. Common examples in Australia are $90,000 Hilux financed at a 7% interest. That is a big liability. Another liability that we see some people is when they've got $250,000 of cash earning 3% when inflation's running 3 to 4%. They're actually going backwards or they're financially stagnant. A diversified portfolio that's yielding an income of 4 to 5% plus growth, that's an asset. I'm going to use some real numbers. If you've got $750,000 invested earning at 5%, that's roughly $37,500 per annum before touching the capital. If you've got the age pension in there that you may be partially eligible for, you're structurally comfortable. But that $750,000 sits overly defensive at a 2 or a 3%. Your purchasing power erodes. At 3%, it's just keeping up with inflation, and that money halves in purchasing power in about 24 years' time. Time is now your opponent at a conservative investment level, earning 3%. Structure matters more than fear. Hi there, just jumping in. Thanks so much for watching this video. I've got Jordan, my client liaison here. He's the one you're going to speak to if you've got some questions about if we can help you. Click in the description below. We've got the booking link as well as a score app that'll help you understand where you're at. No obligation. Jordan's much more friendly than we are. He's got some great answers to some of your questions. Look forward to seeing you soon. Thanks. Back to the video. Number 4, scarcity mindset, the quiet retirement killer. Scarcity sounds like, what if I run out? What if the market crashes? What if something goes wrong? But here's the truth. Most men and women over 55 who've worked consistently are not broke. They're cautious, and there's a difference. Scarcity causes an overweight asset allocation to cash, an underweight investment, delayed retirement, and lifestyle hesitation. Think of that money thermometer. The average male life expectancy in Australia is around 81 years old. So if you retire at 60, 61, you've got about 20 years left. If you retire at 65, 15 years left. The goal isn't to die with the largest super balance possible. You don't want to reward yourself for dying with the most money. The goal is to convert capital into a confident living. Abundance thinking is at this stage, it doesn't mean reckless risk. It means structured asset allocation, keeping up at beating inflation, providing that lifestyle that you want. The 5th element of money psychology is why some men hold on too long. Research shows losing $100 feels twice as painful as gaining $100. That's loss aversion. In practical terms, holding underperforming shares for 12 years is one of those things. Another is refusing to rebalance your super. It may be staying too conservative after markets recover. So we've had a big run and you're still sitting in your cash to like portfolio, or might be in a balanced portfolio. Delaying retirement because of just one bad year. I've seen men and women hold $100,000 in poorly performing assets for a decade, waiting to just get back to even though we had a portfolio that we felt had a better growth chance, better diversification, and overall a better asset allocation towards their risk profile. An asset allocation at 7%, which we have portfolios that we feel will do this, will roughly double over 10 years. Opportunity cost is silent. Every experienced investor has paid it. The difference is whether you learn from it. Number 6, the time trap. Your most valuable asset now. At 30, time is abundant. At 60, time is precious. Money compounds, time does not. If you earn $120,000 per annum, divide by 2,000 working hours, that's about $60 an hour. Now ask, are you spending time on $20 an hour tasks instead of financially structuring, working on your health, working on your strategy, working with your family and having a wonderful time with them? In your retirement years, this means simplifying your portfolio, automating your income, reducing your stress, and buying clarity. The wealthy protect more than they protect small expenses. They protect their time. The wealth framework for Australians over 55 is, if you want clarity moving into retirement, focus on upgrading your financial identity, moving from fear-based cash holding to structured income producing assets, understand how inflation erodes your purchasing power, reframe losses as part of experience, protect your time, because at this stage, the game is not about a hustle. It's about calm, structured, intelligent allocation. This is a bit of a different podcast, but this is one that I'm super passionate about, and I'm really thankful for you still being here. Hopefully you've learned some things, and hopefully you've had a little bit of think about how you invest your money and how you think about your time. What I'll reiterate is you probably don't need more hustle, you need more alignment. Most of you are closer to financial confidence than you think. The gap is psychological, not mathematical. So start with one shift, rewrite your money script, reassess your asset mix, reframe just one fear-based asset allocation. Wealth in your frame of life is about control, not mass accumulation, and that starts in the mind. Thanks so much for watching this episode today. I know it's a bit of an odd one, but I've really enjoyed pulling it together. I find psychology and money so interesting. It's such a huge driver of wealth accumulation, and having sat across literally thousands of people now, helping them in their retirement, this is one of the most powerful things that you can use in your life. Thanks so much. Phil's back next week. We'll see you then.